For most people, the tax code feels like this giant, complicated burden, right? It's just a system designed to take our hard-earned money. But what if that's completely the wrong way to look at it? Today, we're going to flip that script. We're going to reframe the tax code from a trap into a strategic blueprint, a set of rules that when you actually understand them can guide you toward building serious wealth. Let's dig in and uncover some of these secrets hidden in plain sight.
So first, let's just get a handle on the stakes here. According to expert analysis, when you start combining federal and state taxes, it's not uncommon for high-income earners to see their total tax bill get real close to or even climb right past 50% of their income.
I mean, just let that sink in for a second. For a lot of people, taxes are their single biggest expense over their entire lifetime. We're talking more than your house, more than your cars, more than anything else. It is a staggering amount of your capital just walking out the door, year after year after year.
Okay, but here's where we make the big perspective shift. Instead of seeing it as a trap designed to catch you, what if the tax code is actually a map? See, it's packed with incentives, deductions, and loopholes. And the government put them there for a reason. They want to encourage certain behaviors, like investing in the economy and creating jobs. So the key isn't to fight the code, it's to understand the rules of the game and use them to your advantage.
And look, to play any game well, you have to understand the board first. When it comes to taxes in the United States, that means getting your head around the progressive tax system.
So here's the deal. The system is specifically designed to take a bigger and bigger slice of your pie as that pie gets larger. The top federal tax bracket alone is 37%, and that's before states like California or New York come asking for their share, which can be over 13%. It's that constant climb that makes strategy not just helpful, but absolutely critical if you're serious about creating wealth.
All right, let's get into our first strategic tool. This is a big one, the Limited Liability Company, or LLC. Think of this as the foundational building block for pretty much everything we're going to talk about, protecting your assets and optimizing your taxes. Now, the LLC is brilliant because it does two absolutely crucial things at once. First, you get that limited liability. It basically builds a legal fortress around your personal life. So if your business gets sued, they sue the LLC, not you. Your house, your car, your savings, they're safe. Second, it gives you incredible tax simplicity with what's called pass-through taxation. The LLC itself doesn't pay a dime in income tax. Instead, the profits just pass right through to your personal tax return. This helps you avoid that nasty double taxation that corporations deal with. The business gets taxed, and then you get taxed again on the profits. It's protection and efficiency all in one.
Okay, so you've got your LLC. It's up and running, and it's starting to make some real money. Now it's time to level up. This is where we introduce the S-Corp election. It's a strategic move you can make with your LLC to unlock some major tax savings.
According to the experts, the magic number is usually somewhere around $50,000 in net profit. Once your business is consistently hitting that mark, the S-Corp strategy goes from being a good idea to an incredibly powerful one. And this slide shows you exactly why. Check it out. With a standard LLC, that entire 100 grand profit gets hit with a 15.3% self-employment tax for Social Security and Medicare. Ouch. But if you elect to be treated as an S-Corp, you can legally split your income. You have to pay yourself a reasonable salary, let's say 30 grand in this example. And yeah, that part is subject to the 15.3% tax, but here's the genius part. The other $70,000 can be paid to you as a profit distribution, which is not subject to self-employment tax. That little split can save you thousands of dollars. All right, let's pivot from business structures to a specific type of asset that has some of the most powerful tax breaks in the entire code, real estate. And this isn't just about owning a property. It's about using a very unique tax-saving engine. The secret weapon here is a concept called depreciation. The tax code basically says, hey, your building is getting older, so we'll let you deduct a piece of its value every year for wear and tear.
For a residential property, you get to spread that write-off over 27.5 years. But here's the thing that changes the game. This is a non-cash deduction. It's a tax expense you get to claim without ever actually spending a dollar that year.
And that non-cash expense leads to this amazing outcome called a paper loss. So get this, you can be collecting rent checks every single month, cash is flowing into your bank account, your property value is going up, but on your tax return, depreciation can make it look like you lost money. This loss then gets to lower your overall taxable income. You are literally making money in the real world while legally losing money on paper. It's incredible. Now, if you want to put this whole strategy on steroids, experts recommend something called a cost segregation study. You hire an engineering firm to come in, analyze your property, and they separate things like carpets, appliances, and fixtures from the actual building structure. Why? Because those smaller items can be depreciated way faster, like over 5 or 7 years instead of 27.5. This front loads all your deductions, giving you a massive tax savings right in the first few years you own the property. Okay, so we've just created these really powerful paper losses from our real estate. But here's the big question. How do we use them to lower the taxes on the income from our main job or our main business? Well, to do that, we have to get around a major roadblock in the tax code. And that roadblock has a name, the Passive Activity Loss Rules, or PAL rules for short. And you have to know, these were put in place for the specific reason of stopping most people from doing exactly what we want to do. So here's how it works. The tax code puts your income into different buckets. By default, rental real estate is automatically considered a passive activity. This means those amazing paper losses we just talked about, they're stuck in the passive bucket. They can only be used to cancel out passive income, like profits from your other rentals. They can't cross over that line to reduce the taxes on your active income. You know, the money you make from your W-2 job or your main business. But like any set of rules, the PAL rules have exceptions. And these exceptions are like keys that unlock the full power of this whole real estate strategy. So the question is, how do savvy investors legally get around this roadblock? Well, there are two main keys that can open that door. Key number one is the short-term rental loophole. If the average guest stay at your property is 7 days or less, and you materially participate by spending over 100 hours a year managing it, guess what? It's not considered a passive activity anymore. Those losses can now offset your active income. Key number two is achieving what's called real estate professional status. If you spend over 750 hours a year in the real estate business, and that's more than half of your total work time, you can also treat your rental losses as active, non-passive losses. We have covered all the individual tools, the LLC, the S-Corp, these powerful real estate strategies. Now let's put all the pieces of the puzzle together and assemble them into a cohesive structure. The kind of financial fortress that the wealthy use to protect and grow their assets for generations. Experts often call this the T formation, and it's a beautifully simple way to visualize it. On the left side of the T, you've got your active, operational businesses, your S-Corps and LLCs that are out there generating income. On the right side, you have separate LLCs that do nothing but hold your safe assets, like your real estate. And at the base of the T, connecting and owning everything, is a trust, which handles all your long-term estate and legacy planning. And this right here is the whole point. The genius of this structure is separation. Your high-risk, active businesses are legally walled off from your safe, valuable assets. So if one of your businesses fails or gets sued, your real estate portfolio is completely safe. And because the trust owns everything, it ensures a smooth, seamless transfer of wealth to the next generation. So really, the final question is this. Is the tax code something that just happens to you every year? Or is it a blueprint you can actually use? By understanding these rules and playing the game, you can shift from just earning an income to actively engineering a financial legacy.